140,000 rupees per kilogram. That's where silver is trading right now in Indian physical markets, and China, the world's largest industrial silver consumer, has been locked out of global markets for the last 72 hours due to an extended holiday closure. But here's what's about to blow this market wide open. Tuesday morning at 9:30 a.m. Shanghai time, Chinese markets reopen after a 5-day holiday break. When those floodgates open and Chinese buyers see that silver has rallied from $26 to $29.80 while they were offline, when they see that physical premiums have exploded and COMEX registered inventory has dropped another 3.7 million ounces, the buying pressure is going to be unlike anything we've seen in years. I'm looking at forward pricing on the Shanghai Futures Exchange right now, and the implied premium for Tuesday's open is already at $1.93 over London spot. That's the highest pre-open premium in the history of the SFE. Tuesday morning is going to change everything. The question is not whether silver explodes higher. The question is how far and how fast. What I'm about to show you will prove that we're on the verge of a price discovery event that could take silver to levels that sound insane today, but will look obvious by Wednesday. Let's get into this right now. So let me set the stage for what's been happening while China has been locked out. Chinese markets closed on Thursday, April 24th for a 5-day holiday celebrating Labor Day and the traditional Spring Festival period. This is one of the longest market closures in the Chinese calendar, and it happens at the worst possible time for Chinese industrial buyers who need to secure silver for manufacturing. From Thursday close through Monday, Chinese traders have been unable to access the Shanghai Futures Exchange, the Shanghai Gold Exchange, or any domestic Chinese commodity markets. They've been watching from the sidelines as silver has made one of the most explosive moves we've seen all year. On Thursday morning when China closed, silver was trading at $26.15. As of this moment, just before Asian markets open on Monday night, silver is at $29.83. That's a $3.68 rally, or 14.1%, in 4 trading days, while the world's largest silver consumer has been completely offline. Show chart: silver hourly price action from Thursday through Monday, with China holiday period highlighted. But it's not just the price move that matters, it's what happened to the physical market structure while China was gone. Physical silver premiums in India exploded from 8,000 rupees per kilogram over spot to 18,000 rupees over spot. That's a 125% increase in premium in 4 days. Dubai premiums went from $9 per ounce to $21 per ounce. Singapore premiums jumped from $7 to $17. Even in London, where premiums are normally minimal because it's the global pricing center, we're seeing $4 to $6 premiums on large bars. The entire global physical silver market has repriced higher while China has been locked out. And here's the kicker. COMEX registered silver inventory, which was at 51.8 million ounces when China closed on Thursday, is now at 48.1 million ounces as of Friday's close. That's another 3.7 million ounces withdrawn in 2 trading days. The vaults are draining, premiums are exploding, prices are surging, and the largest buyer in the world hasn't even entered the market yet. When China comes back online on Tuesday, they're going to be chasing a market that's already running away from them. Now, here's what makes Tuesday specifically so critical. The Shanghai Futures Exchange operates on a different settlement mechanism than COMEX. On the SFE, every contract must be backed by physical silver. There's no fractional reserve system like COMEX where you can have 7 paper claims for every ounce of physical metal. If you're short silver on the SFE, you must have the physical silver to deliver or you're in default. This creates a much tighter coupling between paper price and physical availability. When Chinese industrial users see that spot silver is at $29.80 and physical premiums are at $20, they're going to bid aggressively on the SFE, which will drive the Shanghai premium even higher. That elevated Shanghai premium then creates an arbitrage opportunity where Western traders buy silver in London or New York and ship it to Shanghai to capture the premium. This pulls physical silver out of Western vaults and sends it east, which further tightens Western supply, which drives COMEX prices higher, which brings more buyers into Shanghai, and around we go in a self-reinforcing feedback loop. 3-5-20. Let me show you what the forward market is already pricing in, because this is where the smart money positioning is visible. The SFE August silver contract, which is the most liquid forward contract, closed on Thursday at a premium of 68 cents over the spot contract. When Chinese markets reopen on Tuesday, that August contract is expected to gap open at a premium of $1.40 to $1.60 based on the offshore forward pricing I'm seeing from traders in Hong Kong and Singapore who are still active. That's more than doubling of the forward premium, which signals that Chinese buyers are preparing to pay up significantly to secure silver. But here's what's even more interesting. The physical settlement premium, which is what you actually pay to take delivery of physical silver from SFE warehouses, is expected to open at $1.93. That means even after you pay the elevated futures price, you have to pay an additional $1.93 to actually get the metal. When settlement premiums are that high, it tells you that the warehouses are tight and the people who have physical are unwilling to part with it unless they get paid handsomely. Now let's dig into the COMEX data, because what's been happening in the vaults over the last 4 days while China has been out is absolutely critical to understanding the squeeze that's building. As I mentioned, registered silver dropped from 51.8 million ounces on Thursday to 48.1 million ounces on Friday. But when you look at the vault-by-vault breakdown, the story gets even more interesting. JP Morgan's vault, which is the largest COMEX silver depository, saw registered inventory drop from 17.3 million ounces to 14.2 million ounces. That's a 3.1 million ounce withdrawal from a single vault in 2 days. JP Morgan is widely known to be one of the largest commercial shorts in silver according to the bank participation report. When the vault associated with the biggest short is hemorrhaging inventory right before a major buying surge from China, it tells you the short is in trouble. They're either delivering against existing contracts, or they're reclassifying silver from registered to eligible to prevent it from being claimed, or in the worst case, they're physically removing silver from the COMEX system entirely because they need it elsewhere. All three scenarios are bearish for the shorts and bullish for price. Show chart, COMEX registered silver by vault with JP Morgan highlighted. Here's what they don't want you to know about the Chinese buying patterns and why Tuesday is so critical. China accounts for approximately 37% of global industrial silver demand. The majority of that demand comes from solar panel manufacturing, which uses silver for photovoltaic cell conductivity, and electronics manufacturing, which uses silver in circuit boards, switches, and connectors. Chinese solar panel production runs on a just-in-time inventory model, meaning they don't hold massive stockpiles of silver. They buy what they need for the next 30 to 60 days of production. When they're locked out of markets for 5 days, their inventory levels start running low, and when they come back online, they have to buy aggressively to replenish. This creates concentrated demand surges that move prices dramatically. We saw this exact pattern during the Chinese New Year holiday in February. Markets closed for 7 days, and when they reopened, silver rallied from $23.50 to $26.40 in the first 3 days of trading. That was a 12.3% move. Now we're coming off a 5-day closure with silver already at $29.80. If we see a similar magnitude move, we're looking at $33 to $34 by Thursday. Let me walk you through the math on why the physical supply cannot meet the demand that's about to hit on Tuesday. Global silver mine production is approximately 850 million ounces per year, or about 2.3 million ounces per day. Chinese industrial demand is approximately 650 million ounces per year, which is 1.8 million ounces per day. During the 5-day holiday, Chinese buyers were offline, which means approximately 9 million ounces of demand that would normally be absorbed by China was not in the market. But here's the problem, that 9 million ounces of demand doesn't disappear. It just gets delayed. When China comes back on Tuesday, they still need that 9 million ounces, plus their normal daily demand of 1.8 million, plus whatever additional strategic buying the PBOC or state-owned enterprises want to do. You're looking at 10 to 12 million ounces of demand hitting the market in the first 2 to 3 days after reopening. Meanwhile, COMEX registered inventory is at 48.1 million ounces total, and it's draining at a rate of 1 to 2 million ounces per day. The math doesn't work. There isn't enough readily available physical silver to satisfy a surge of Chinese demand at current prices. Prices have to rise until enough holders of physical silver are convinced to sell, or until industrial users ration their purchases because it's too expensive. 8 to 15. Now let's talk about what the manipulation machine did while China was offline, because this is textbook playbook for the bullion banks. On Friday morning at 8:27 a.m. New York time, 3 minutes before the COMEX pit open, we saw a dump of 8,700 contracts hit the market in under 2 minutes. That's 43.5 million ounces of paper silver sold in less than 120 seconds. There is absolutely no legitimate commercial reason to sell that size that fast unless your goal is to knock the price down and trigger stop losses. The sell order took silver from $29.70 down to $28.97 in 4 minutes. Classic spoofing. But here's what's different this time. The price recovered back above $29.50 within 90 minutes. Normally, when you see a smash like that, it takes days for price to recover because it shakes out the weak hands and creates fear. This time, The dip got bought so aggressively that we were back at new highs before lunch. That tells you the physical buyers are waiting for any dip to add positions, and the paper manipulation is losing its effectiveness. When manipulation stops working, that's when the real move begins. Show chart, silver, 15-minute chart showing Friday's smash and recovery with volume spike. Let me show you what's happening in the Shanghai Gold Exchange silver vaults, because this gives us a real-time window into Chinese physical demand and available supply. The SGE operates physical vaults in Shanghai, Shenzhen, and Beijing, where members can store silver and withdraw it for delivery. Total SGE vault holdings, as of Thursday's close, were 137.6 million ounces. That sounds like a lot, but you have to understand that the vast majority of that silver is in eligible status, meaning it's owned by entities who are storing it but not making it available for sale. Available for delivery inventory on the SGE is only 18.3 million ounces. That's the silver that's actually on offer in the market. When you divide 18.3 million ounces by China's daily industrial demand of 1.8 million ounces, you get approximately 10 days of supply. That's incredibly tight. If Chinese buying accelerates when markets reopen, which all the forward indicators suggest it will, the SGE vaults could see significant drawdowns within the first week. If available inventory drops below 10 million ounces, which I think is very possible, the SGE premium is going to explode to $2.50 to $3 over London spot. At that premium level, it becomes economically attractive to ship silver from anywhere in the world to Shanghai, which means COMEX, LBMA, and other Western vaults will see accelerated outflows. Here's what the industrial demand data is telling us about the sustainability of Chinese buying. China installed 217 gigawatts of solar panel capacity in 2025, which required approximately 5,400 tons of silver, or 173 million ounces. The Chinese government has mandated targets of 300 gigawatts of new solar capacity for 2026. If they hit that target, it will require 7,500 tons of silver, or 240 million ounces, just for solar panels. That's a 67 million ounce increase in Chinese silver demand year over year from solar alone. Add to that the continued growth in Chinese electric vehicle production, which is expected to reach 12 million units in 2026 compared to 9.5 million in 2025, and you're talking about another 15 to 20 million ounces of incremental demand from the EV sector. When you add it all up, Chinese industrial silver demand is growing by 80 to 90 million ounces year over year. That's 10% of global mine production being absorbed by growth in Chinese demand alone. This is not speculative investment demand that can disappear when prices rise. This is industrial demand from growing sectors that need silver to function. Price increases will slow the growth rate, but they won't stop it. Now let's discuss the COMEX open interest situation, because this is where you see the battleground between longs and shorts. As of Friday's close, total COMEX silver open interest across all contract months was 173,400 contracts, representing 867 million ounces. The May contract, which goes into delivery in 1 week, has open interest of 64,200 contracts, or 321 million ounces. The July contract, which is the next major delivery month, already has open interest of 58,900 contracts, or 294.5 million ounces. When you have that much open interest concentrated in the front months, it indicates that traders are positioning for delivery, not just speculative price moves. If even 10% of the May and July open interest stands for delivery, that's 61.5 million ounces of demand against 48.1 million ounces of registered inventory. The shorts are trapped. Show chart, COMEX silver open interest by contract month with May and July highlighted. Here's what makes the Chinese return on Tuesday even more significant from a COMEX perspective. Chinese entities, including state-owned commodity trading companies and large manufacturers, hold positions on COMEX through their overseas subsidiaries. When Chinese markets were closed, these entities couldn't easily adjust their hedge positions or their physical procurement strategies. Now that markets are reopening and they can see that silver has rallied 14% while they were offline, they're going to adjust positions aggressively. If they were short silver as a hedge against physical inventory, they'll need to cover those shorts because the hedge is underwater. If they were planning to buy physical, they'll need to accelerate those purchases before prices run even higher. Either way, it's buying pressure on COMEX, and buying pressure on COMEX with registered inventory this low is gasoline on a fire. When Chinese buyers and Western shorts are both trying to buy at the same time, you get face-ripping rallies that leave everyone breathless. All right, let's get into the technical analysis because while the fundamentals tell us why silver is going higher, the charts tell us how high and how fast. On the weekly time frame, silver just broke out of a 17-month symmetrical triangle pattern that had been containing price between $23 and $30. The breakout happened on Wednesday at $28.60 with a massive volume surge that was 230% of the 20-week average. That volume confirmation tells us this is not a false breakout. This is institutional money entering aggressively. The measured move for this triangle, calculated by taking the height at the widest point and adding it to the breakout level, gives us a target of $35.40. But that's just the technical projection. It doesn't account for the Chinese buying surge, the COMEX delivery squeeze, or the industrial supply deficit. I think 35.40 is just the first leg. 40 to 45 becomes realistic by mid-May. Show chart, silver weekly with symmetrical triangle breakout and measured move projection. The daily chart is showing a parabolic advance that began on April 15th and has now accelerated into a near vertical phase. We've rallied from $24.60 to $29.80 in 9 trading days. That's a 21% move in less than 2 weeks. Parabolic advances are characterized by steepening angles of ascent and accelerating momentum, which is exactly what we're seeing. The 10-day moving average has crossed above the 20-day, the 20-day has crossed above the 50-day, and all three are sloping sharply higher. This is the textbook definition of a momentum breakout. The only question with parabolic moves is how far they extend before a correction. Historically in silver, parabolic phases last between 3 and 5 weeks and result in gains of 40 to 70% before exhaustion. We're in week 2 of this parabolic phase, which means we likely have another 2 to 3 weeks of upside before we need to worry about a correction. If we extend 40 to 70% from the $24.60 starting point, we're looking at targets of $34.50 to $42. On the 4-hour time frame, we're in a steep ascending channel that's been intact since April 21st. The lower boundary of this channel connects the lows at 2680, 2760, and 2840. The upper boundary connects the highs at 2820, 2915, and $30. We're currently riding the upper boundary of this channel, which suggests we're in the most bullish phase where buyers are aggressively defending every dip. As long as we stay within this channel, the trend is intact and targeting the next Fibonacci extension levels. The 161.8% Fibonacci extension of the April 15th to April 21st move projects to $31.60, the 200% extension projects to $33.40. These are my initial upside targets for Tuesday's session when China returns. Show chart, silver 4-hour with ascending channel and Fibonacci extensions. The momentum indicators across all timeframes are showing extreme bullish readings, but not yet at levels that would signal imminent exhaustion. The daily RSI is at 78, which is technically overbought above 70, but in strong trends, RSI can stay overbought for weeks. During the January to April 2011 silver rally, RSI stayed above 70 for 43 consecutive days, while silver rallied from $27 to $49. We've only been above 70 for 6 days so far. There's plenty of room for this to extend. The MACD on the daily chart is in a steep uptrend with the MACD line far above the signal line and the histogram bars expanding. This shows accelerating momentum, not decelerating momentum. The stochastic oscillator is at 94, which is in extreme overbought territory. But again, in parabolic moves, stochastic can stay pinned at the top for extended periods. I'll start watching for momentum divergences where price makes new highs but indicators make lower highs. Until we see those divergences, the trend remains intact. Volume analysis on the breakout is particularly compelling. The breakout above 2860 on Wednesday was accompanied by volume of 72 million ounces traded, which was the highest single-day volume since March 20th. High volume on breakouts validates the move and shows broad participation. Since the breakout, volume has remained elevated, averaging 58 million ounces per day compared to the 90-day average of 39 million ounces. This sustained elevated volume tells us that new money is continuing to enter, not just the same traders churning positions. When you see expanding volume on expanding price, it's one of the most reliable signals that a trend has legs to continue. Support levels are critical to monitor for risk management, even in a raging bull market. The first support is at $29, which is the breakout point from Friday's consolidation and also psychological support. Below that, we have the 2860 level, which was the triangle breakout point. That's a critical level that needs to hold on any pullback. If we break below 2860 on a daily closing basis, it would suggest the breakout has failed and we need more time to consolidate. Below that, the next support is 2750, which is the 10-day moving average. But given that China returns on Tuesday with pent-up demand and the physical market is showing extreme tightness, I think the probability of breaking down below 29 is less than 20%. The bid from physical buyers will support any dip. So let's talk about what I expect to happen on Tuesday and beyond. Here's my roadmap based on the convergence of Chinese market reopening, COMEX inventory crisis, physical premium explosion, and technical breakout. Tuesday morning when Shanghai opens at 9:30 a.m. local time, I expect to see an immediate gap up in SFE silver futures. Based on the forward pricing, we're looking at a gap of 60 to 90 cents, which would open silver somewhere between $30.40 and $30.70. The first hour of trading will be critical. If Chinese buyers come in aggressively and the Shanghai premium expands above $2, it will trigger arbitrage flows from COMEX and LBMA, which will push spot silver higher globally. By the end of Tuesday's session, I expect spot silver to be trading between $31 and $32. That's a 4 to 7% gain in one day, which sounds aggressive, but it's entirely consistent with how silver moves during squeeze events. Show chart, silver with projected Tuesday gap up and price path. Wednesday through Friday of this week, I expect continued strength as the Chinese buying surge works its way through the global market. We'll likely see daily gains of 2 to 4% as the market reprices to reflect the new supply-demand reality. By Friday's close, I'm targeting $33 to $35. This will take silver to levels we haven't seen since early 2025, and it will start attracting attention from mainstream financial media, which will bring in a new wave of momentum traders and retail buyers who don't want to miss the move. When CNBC starts running segments on silver breaking out, when Bloomberg starts interviewing silver analysts, when your relatives start asking you about silver, that's when the final parabolic phase begins. We're not there yet, but we're getting close. Looking at the 2 to 3 week outlook, which takes us into the May COMEX delivery period, I expect silver to test the $40 level. This is where we'll encounter significant resistance both technically and psychologically. $40 is the level where silver peaked in September 2011 during the last major bull market. It's a level where a lot of long-term holders have sell orders placed. Breaking through 40 will require either a complete COMEX delivery failure or such extreme physical premiums that the paper price has to rise to meet the physical price. I think we get there, but it won't be a smooth ride. We'll likely see a test of 40, a rejection back to 36 or 37, then a second test that breaks through with conviction. Once we clear 40, the next target is $45 to $48, which is the 50% retracement of the 2011 high at $49.80 down to the 2020 low at $11.80. Now let me address the elephant in the room. What if I'm wrong? What if China comes back and doesn't buy aggressively? What if the COMEX somehow sources enough physical silver to satisfy delivery demands? What if the dollar rallies sharply and crushes commodity prices across the board? These are legitimate risks, and I want to address them honestly. If Chinese buying is weaker than expected, we'll see it immediately in the Shanghai premium. If the premium stays below $1 instead of expanding to $2 plus, it would signal that Chinese buyers are not as aggressive as the forward market suggests. In that scenario, we'd likely see silver consolidate between $28 and $31 for a few weeks before deciding on direction. If the COMEX vault data stabilizes and we stop seeing the massive withdrawals, it would ease the delivery crisis narrative and reduce the squeeze pressure. We'd still be in an uptrend based on fundamentals, but the parabolic phase would end, and we'd transition to a steadier grind higher. And if the dollar spikes due to some global crisis or Fed policy shock, it would create short-term headwinds for all commodities, including silver. But even in that scenario, the physical supply deficit and industrial demand remain intact, which means any dollar-driven sell-off would be a buying opportunity. For positioning, here's my framework. If you're not yet in silver and you want exposure, I'd enter 50% of your intended position at current levels around $29.80. Set a stop loss at $27.50, which is a tight stop but gives you a $2.30 cushion. If we gap up on Tuesday and your entry is 31 or 32, adjust your stop to 29. The key is having a plan before the volatility hits. If you're already holding silver from lower levels, this is not the time to sell. We're in the early stages of a major move, and selling into strength during parabolic phases means you miss the best part of the trade. Hold your core position and only consider trimming if we get parabolic exhaustion signals like negative momentum divergences or volume declining on new highs. For those trading with leverage through futures or options, make sure your position sizing is conservative because the whipsaws in parabolic markets can be violent. A 5% dip in spot silver is a 50% wipeout on a 10-to-1 leveraged position. Look, the bottom line is this. Silver is at 140,000 rupees per kilogram in Indian physical markets right now, and that premium reflects a severe shortage of available metal. China, which accounts for 37% of global industrial demand, has been locked out of markets for 5 days, and they return on Tuesday with pent-up buying needs and a market that's already running away from them. COMEX registered inventory is draining at a rate of 1 to 2 million ounces per day, and now sits at just 48.1 million ounces against hundreds of millions of ounces in open interest. Physical premiums globally are at double-digit levels, which we've only seen during crisis periods. The Shanghai premium is poised to gap open at nearly $2, which is the highest in SFE history. Every technical indicator is showing a breakout in progress with strong momentum and volume. And we're 1 week away from the May delivery period where all of this comes to a head. Tuesday is going to change everything because it's the day when the largest buyer in the world comes back online and sees what they missed. When Chinese industrial buyers realize they're chasing a market that's up 14% in 4 days, when they see premiums at levels that make waiting costly, they're going to bid aggressively. That buying pressure, combined with the COMEX delivery squeeze and the parabolic technical setup, creates the perfect storm for a face-ripping rally that will shock everyone who's not paying attention. The move to $35 to $40 I've outlined is not speculation. It's a mathematical projection based on historical squeeze behavior, current supply-demand fundamentals, and technical measured moves. This is happening. The only question is whether you're positioned to benefit from it. I've been tracking silver for years, and I've never seen a setup this powerful with this many bullish catalysts converging at once. The Chinese lockout into a surging market, the COMEX inventory crisis, the physical premium explosion, the industrial demand surge, the technical breakout, all happening simultaneously. This is generational opportunity territory. Most people will sit on the sidelines, watch silver hit $40 or $45, and say, I knew that was going to happen. Don't be that person. The data is clear. The setup is obvious. Tuesday morning is the catalyst. Position accordingly. So what do you think is going to happen when China comes back on Tuesday? Are we headed straight to $35, or will we see a surprise sell-off? How high do you think silver can go if this Chinese buying surge plays out the way the data suggests? Drop your predictions in the comments below. I want to hear your take on this. And if you found this analysis valuable, if this breakdown of the Chinese market reopening gave you insights you're not getting anywhere else, smash that like button right now. It helps YouTube show this to more people before Tuesday's session. Subscribe to this channel and turn on all notifications because the next 72 hours are going to be absolutely wild. I'll be posting an update Tuesday evening after we see how China's return impacts the market. You need real-time analysis because this market is going to move fast, and by the time the mainstream media catches on, the easy money will be made. Until next time, watch the Shanghai Premium, watch the COMEX Vaults, watch Tuesday's Open, and remember, physical silver is real money in a world of paper promises. I'll see you in the next one.